Warren Buffett is considered the most successful investor of all time. He started investing in 1941 and today, almost 85 years later, his portfolio is worth $274 billion. But what is his secret? How is he able to pick stocks that grow in value over many decades? Well, first, what you have to understand is that a company's rational stock price growth is based on its financial growth, net income, revenue, and mainly free cash flow, which is what we will have a look at today and what Warren Buffett has used as one of his buy indicators for his whole career. But how do you use this free cash flow to predict the future value of a company? Well, let's jump to our discounted cash flow model, which is the easiest and most reliable way to value companies based on their future free cash flow, like Warren Buffett. What we will do here is value Visa based on their future free cash flow, so the free cash flow they will generate in the next 8 years plus. And by doing this, we will calculate the company's intrinsic value. So first, we will plug in the free cash flow over the past 5 years. You can do this by going to Seeking Alpha, moving to Financials, Cash Flow, and scrolling all the way down and taking the unlevered free cash flow from 2020 to 2024. I do have Seeking Alpha Premium, but with a free account you will be able to see the financials up to 2020, so that is all good. Now, after plugging in the historical free cash flow, the model calculates the yearly growth and averages it out to a 5-year CAGR of 14.61%. But now we have to project the future free cash flow growth. So based on our historical growth and the research I did in the backend, I will project the high growth rate at 15% yearly, medium at 13% and low at 9%. And averaging these out, we will get an average growth rate of 12.3% into the future. We will then use this to calculate the future free cash flow from 2025 to 2035. After that, we will calculate the terminal value by taking the free cash flow from 2033 and combining it with the perpetual growth of 2.5% and the discount rate of 7.9%. But now we have to calculate the present value of that future free cash flow. And to do this, we will again use the discount rate, which is essentially the minimum rate of return you would like from an investment into a company yearly. Now, to get this minimum rate of return close to the actual one, I base it on the WACC of the company, that is the weighted average cost of capital, and you can easily find it on Google. I will project my high year-over-year return at 10%, medium at 8% and low at 6%, combine it with the WACC and get the discount rate of 7.9%. We will then take this and use it to calculate the present value of that future free cash flow, including the terminal value. Now, to carry on with the valuation, we have to sum all of it up and add the company's cash and cash equivalents negative their total debt, and you can find both of these again in the balance sheet in Seeking Alpha. After doing this operation, we will get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $310.62, which, as you can see, is lower than the current trading price. And this would tell us that Visa is currently slightly overvalued compared to their future free cash flow, so you might want to wait for their price to drop a little lower before buying. If you find this model helpful, by the way, you can download a copy of it at the link in the description for free. But now that we have valued Visa using the free cash flow model, let's value one more company, but using a slightly different approach. So jumping to my fully automatic stock valuation spreadsheet, I will plug in Pepsi's ticker and all the metrics will show up automatically. Now, these sheets include the general company info, but they also include the fundamental 9-pillar analysis, which consists of the 9 most important metrics every investor should consider before buying a company, such as the 5-year PE and price to free cash flow ratios, the company's revenue, net income and free cash flow growth, their debt levels, dividend safety and growth, etc. You can also zoom in onto these individual pillars and value the company at an even closer level. And currently we are running a New Year discount, which has been prolonged to the 10th of February. So if you want to pick up these valuation sheets for $20 instead of $25, now is the best time. You can find the link to these sheets, including the discount code, at the link in the description. But now let's calculate the intrinsic value of Pepsi, first using the discounted cash flow model, which this time is fully automatic. So after plugging in the ticker in the stock screener, all the values are filled in automatically. So all you need to do is predict the future free cash flow growth and the year-over-year return. And so looking at the average growth rate over the past 5 years sitting at 12.23%, and based on the research I did in the backend, I will predict the high growth at 6%, medium at 5% and low at 3%, which will give me a calculated growth rate into the future of 4.7%, which I will use to calculate the future free cash flow over the next 8 years, including the terminal value. Afterwards, I will average out my high, medium and low year-over-year return estimates with the WACC of the company and calculate a discount rate of 6.6%, which I will use to calculate the present value of that future free cash flow. I will then sum all of it up, add cash and cash equivalents and subtract total debt to get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $149.44, which as you can see is very close to the current trading price. Now on top of using the discounted cash flow model, let's use 3 more models, which are the Graham's formula, multiples valuation and the dividend discount model, and will make our final intrinsic value assumption much more accurate. First, in the Graham's formula, the intrinsic value of a company is calculated based on its earnings per share. So first we have to calculate the 5-year earnings growth estimate, which I calculated at 5.79% using the same method as before. I will then combine this with the 5-year earnings per share, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and this will give me an intrinsic value of $111.14, which is actually 34% lower than the current trading price. Now for the second valuation model, we will jump to the multiples valuation, where we will compare Pepsi to 3 of its competitors, so Coca-Cola, Mondelez, and Monster Beverage. We will take these companies' current stock prices and divide by their earnings per share to get their PE ratios, which we will average out and multiply by the earnings per share of Pepsi to get an intrinsic value of $174.28, which is higher than the current trading price. And this intrinsic value is higher than the current trading price because the PE ratio of Pepsi is lower than the average PE ratios of these 3 companies, because investors are paying less money for every dollar of Pepsi's earnings than what they would be paying for a dollar of earnings of these 3 companies. But now let's jump to our final valuation model, the dividend discount model. And here we will take the dividend payouts over the past 5 years and calculate the average growth rate to be sitting at 6.87%. Now into the future I will project a growth rate of 6.33%, and combining that with the discount rate, we will get an intrinsic value of $233.64, which is quite higher than the current trading price, showing us that Pepsi has very great dividend growth. And finally, we will arrive to the ultimate valuation, where we will average out the 4 valuation models. I will switch the alternative one to the dividend discount model, and we will get an intrinsic value of $167.13, which is 12% higher than the current trading price. Now, whenever you are making an investment, you want to have a margin of safety. My preferred margin of safety is anywhere between 10 and 15%, but this time I will plug in a margin of safety of 10%, and this will give us an acceptable buy price at $150.42, which is very slightly higher than the current trading price, so PepsiCo would currently be a buy based on the intrinsic value we have calculated using our 4 valuation models. So if you want a way to value your stocks like Warren Buffett, make sure to check out these sheets at the link in the description or download the free version.